Mode.
Hi, good afternoon. This is Benjamin Lavine, Chief Investment Officer with 3D Asset Management. Welcome to our year-end 2016 market commentary. Just some quick housekeeping items. This recording will be made available on the advisor section of our website, as well as the slide deck to this presentation. If you do not have access to the advisor section of our website, please feel free to contact us and we can get you set up. We are also going to do a separate portfolio review where we'll go through the performance and attribution of our ETF model portfolios on Thursday at 3 o'clock Eastern Standard Time. If you're a contracted advisor with 3D, please feel free to register with us, get signed up for that. And again, we'll be getting into a lot more detail about the drivers of performance for both the fourth quarter as well as for the year. With that, just some quick disclosures. We always like to start off with the conclusions to our presentation. And really what this amounts to is a shift in regimes. What we basically saw, and this really goes back to the summer following the June British Brexit vote on the referendum to leave the Eurozone by Great Britain. But essentially what we've seen here is sort of a passing of the baton from one regime to the next. Really, this 2016 can be characterized or classified as being one of two regimes. In the first half, it was the thirst for safety and yield, and then in the second half, it was cyclical reflation. This accelerated following the November elections, but what we saw in the first half diverged dramatically from what we saw in the second half. In the first half, investors expressed a thirst for yield and defensive low volatility assets during the first half of the year as the macro environment remained highly uncertain following China's January devaluation of its currency and renewed capital concerns of the Eurozone banks. However, central banks, which had been pursuing negative rates, shifted policies sometime in the fall to engineer steeper yield curves where the long rates are higher than the short rates so as to support the profitability of lending institutions. This started the reflationary trade that steepened global yield curves and accelerated following the U.S. election in November, leading to one of the worst monthly returns for global bonds based on monthly returns going back to 1976. The markets have now priced in high expectations that the new regime in Washington will produce a more business-friendly environment through deregulation and lower taxes. If so, the resulting demand could drive labor costs higher, which would feed into final prices, prompting the Federal Reserve to be more aggressive in its rate tightening. So in essence, what we saw in the fourth quarter, particularly in November, was the dominance of small cap value style of investing. Small cap value tends to be comprised of financial stocks as well as cyclical stocks, and both really reflect this notion of cyclical reflation. In essence, expectations are that the economy, after having suffered from the new normal environment of low secular growth, will transition to a new cyclical cycle or a reflationary cycle prompted by the new administration. But in essence, it's this sort of populist unleashing that we've seen, the sentiment being that there's the initial concern or the sell-off following a populist outcome like what we saw with the Brexit vote or what we saw with the November election. But then expectations immediately shift to what the implications are for that, namely fiscal stimulus, particularly in the U.S. This just, I think, highlights the importance of global diversification and long-term investing. Again, we're seeing the cycle in leadership from one regime to the next. Certain styles of investing that perform one period end up lagging in the next period. And so the big question right now is will this rush into cyclical risk assets and away from defensive interest rate sensitive assets cause the pendulum to swing too wide the other way? Most of the so-called reflation trade, where we saw the outperformance of small cap value, the US dollar, as well as the underperformance of anything that had interest rate sensitivity, much of that came in November. And in December and so far this month, we've seen a little backing off of that. But again, the sentiment being is that heading into 2017, that this cyclical reflationary trade is expected to dominate all other types of strategies. And so, and ultimately, we need to concern ourselves in terms of positioning is whether investors are being properly compensated for that baseline scenario. It could be that in essence the pendulum does swing the other way. So in essence what we would consider doing and advise investors to do is consider increasing their quality, yield, and interest rate sensitivity or long duration exposure should the market afford more attractive entry points. So we, in the title of our, in the main theme in our market commentary, which we publish on our website, and we get in a lot more detail, is this notion of renormalizing the new normal. We show a picture of a tectonic shift, two tectonic plates essentially shifting and meet each other head on. The one big plate at the bottom is this notion of secular disinflation, or what Bill Gross and Mohamed El-Erian, formerly of PIMCO, had termed the new normal back in 2009, 2010. And the other plate being cyclical reflation. So the first plate, the new normal, characterizes the post-2008 macro environment as one suffering from secular deflationary forces of aging demographics, high debt levels, and excessive global capacity. Any hint of a cyclical recovery was usually met with a crisis, whether it was the European sovereign debt crisis, the China devaluation, the government shutdown that we saw in 2010, or major oil price collapse that we saw in 2014 and 15. There were also disappointments, weak payroll growth, suggesting that though we're in the midst of a bull market coming up on 8 years, and we're well near full employment, one would say that this has been somewhat of a weak, middling type of growth environment. Again, what is characterized by the new normal. The Fed has sought to normalize monetary policy by unwinding quantitative easing and embarking on a path of rate hikes. Yet unwinding quantitative easing has not been easy. Witness the 2013 taper tantrum, the last notable period of bond volatility that we've seen outside of this past November. And the Fed has had to repeatedly backtrack its own forecast for raising rates when the data didn't support raising them. So now questions concerning the depth and the length of this cyclical recovery have turned into a heated debate over the force and impact of the proposed policies from the incoming U.S. administration. The debate also hinges on whether the post-Brexit cyclical recovery has enough momentum to overcome the seemingly great tectonic forces of secular disinflation that have characterized the post-2008 recovery. So here are some questions to consider as we enter a brave new world of renormalizing the new normal. 1, can the incoming U.S. administration reverse the new normal overhang on U.S. business production, and how will such a reversal manifest itself? We're seeing proposals from tax reform to deregulation, but will that also be offset by restrictions on global trade, such as the threat of new tariffs being imposed on imported goods? Will a new round of inflation be unleashed as the new administration seeks to roll back government policies regulating large swaths of the industrial sector, freeing up pent-up growth, but also unleashing demand that could push up prices? And will the Fed's goal to normalize monetary policy and preempt cyclical inflationary pressures by pursuing a more aggressive rate hike policy help subdue any macro credit bubbles that could form during a cyclical recovery? So those are the key questions. Now let's just turn to what happened in the quarter and what happened over the year. Once again, the U.S. dominates most major market regions. It had actually lagged emerging markets up until the November election. And then following the election, with the strength of the dollar and the strength of the U.S. markets, particularly U.S. small caps, U.S. took over leadership over all the other markets. But again, much of this came in the fourth quarter. For the year, the S&P 500 returned 12% versus 4.5% for the MSCI All Country World Index ex-US. And then emerging markets, which had led all other markets for most of the year, turned in a respectable 11.2% in US dollar terms, while Japan and Europe lagged the broader market recoveries, only returning 2.4% and minus 0.4% respectively. Proponents of global diversification, such as yours truly, find themselves having to make the case, once again, for investing in multiple markets rather than a single market, even if the U.S. market makes up over half of the global market capitalization. Our earlier concerns about forward valuations on the S&P 500, which were around 17 to 18 times next 12 months forecast earnings, did not pan out as the forward valuation has now reached 18.8 times next year's earnings. At one point, it was over 19 towards the end of November. However, forward valuations do not lead us to time the markets, as tempting as a proposition that may be. Instead, we focus on areas where we believe we are better compensated for taking on risks within the context of the macro market environment. We are long-term investors who remain fully invested in the markets while maintaining global diversification across regions, sectors, and styles. In the fixed income space, risk dominated all other categories, as you can see with the U.S. high yield index, which performed even better than U.S. large caps. After having been left for dead at an 8% spread above U.S. risk-free debt back in the depths of the February sell-off, U.S. high yield led all major fixed income sectors, returning 17.1% versus 2.6% for the Barclays U.S. Aggregate Index and 1.1% for the B of A Merrill Lynch U.S. Treasury Index. As we've argued in the past, below investment grade high yield ends up being equity beta in sheep's clothing and is a more appropriate asset class to hold in an equity portfolio rather than fixed income. However, it was a great year to be invested in riskier credit. Among equity alternatives, precious metals sold off following the Trump victory, but turned in a respectable year nonetheless. Commodities, led by oil prices, finished the year strong in expectation of higher demand and tighter supplies, assuming OPEC is able to exercise constraints on its members from not exceeding production quotas. REITs had been one of the best performing sectors during the first half, but gave up their gains in the second half when interest rates rose. Among sectors, again, this dynamic of first half versus second half can be shown in sector performance. If you were to look at the sector performance through the first half of the year, this graph essentially would have been flipped. But we can see that given the strong cyclical reflationary recovery that we saw in the second half, most of the cyclical sectors as well as financials ended up dominating sector performance for the year. Cyclical and financial risk not only recovered in 2016, but came back with a vengeance. Having been cast aside during the depths of the January-February sell-off that saw the S&P 500 drop 10% at one point, and oil prices crashing to the mid-$20 a barrel, the energy sector turned out to be the best performing U.S. sector for 2016 with a phenomenal return of 27.4%. This is followed by other value type sectors such as financials and industrials. Sectors that lag the S&P represent a mixture of growth-oriented, higher quality, and safer sectors such as healthcare, real estate, staples, and consumer discretionary. Cyclical reflation can really be seen based on the behavior of the bond market. What we show here are two graphs. One is a long-term view of both the forward inflation expectations embedded in the TIPS versus nominal treasury pricing, TIPS being treasury and inflation protected securities. And then there's the 2 to 10-year yield spread. Essentially, this represents what's known as the yield curve. The wider the spread, the more profitable it is to lend long and borrow short. Fixed income investors either didn't want exposure to duration or interest rate sensitivity or couldn't get enough. Again, in the first half, they couldn't get enough of duration. In the second half, they didn't want any. The second half basically, or the first half was largely driven by their thirst for yield. Yield-hungry investors were willing to expose themselves to longer maturities despite the flattening of the yield curve, where the 2 and the 10-year yield spreads had narrowed. The second half of 2016 saw the emergence of the yield curve steepener, first brought on by central bank policy shifts from engineering negative rates to engineering higher, longer rates to aid lender profitability. This accelerated following the November election, which saw the 10-year Treasury yield rise from 1.78% before the election to roughly 2.6% after the election. We were cautious about sticking one's neck further out the yield curve as the 2 to 10-year term structure narrowed throughout the first half. We highlighted the beginnings of the steepening term structure back in September in an article we titled Mission Accomplished, updated September 2016. Although we believed rates would rise gradually, not anticipating the sharp spike following the election. So where do things stand now? Well, one could argue that at least in treasuries, the pendulum has swung too wildly the other way. This chart shows what is called net non-commercial futures positioning in the treasury futures market. Basically, this is a way for investors to express their bullishness or their bearishness based on whether they're long or short treasury contracts. What this shows is the cumulative net non-commercial futures positioning, such that any line below zero indicates bearishness and any line above zero indicates bullishness. What we highlight here in the red circle is that speculative net interest is at an all-time bearish level. Hedging interest rate risk may be tempting in a reflationary environment, but much of the losses have already been incurred in the fourth quarter, and shorting treasuries feels like a crowded trade, not to mention that hedging interest rate risk is now akin to buying insurance after the catastrophe has already hit. Sure, we could see further sell-off in the bond market, particularly if inflation starts to get out of hand and the market feels like the Fed is behind the curve. But at the very least, the market appears to have largely anticipated the inflationary implications of what a Trump administration might bring, despite the fact that it hasn't started yet. That said, the biggest risk to the bond market is underestimating the degree of tightening the Fed will engineer going forward. The Fed funds futures are only pricing in 2 rate hikes, and they may be negatively surprised if the Fed chooses to get more aggressive. The intermediate part of the curve would be hardest hit as it would have to price in more rate hikes. What is less certain is the impact on the long end of the curve. The long end of the curve could actually flatten as investors would start to price in a Fed that is ahead of the inflation curve or price in deflationary risk from an overly aggressive Fed. Another indication of reflationary animal spirits is what investors are willing to take for risky credit or below investment grade high yield. This graph shows a spread of both high yield spreads as well as the triple B spread. You can see that it's been trending down since it spiked in February of earlier this year. And it's been trending down, but it feels like that even though investors have sold out of bonds in following the Trump election, they still have an appetite for risky credit, willing to take on narrower spreads. We were bullish on credit spreads when they had reached 8% back in mid-February. Although, as mentioned earlier, we believe traditional below investment grade high yield is a more appropriate investment in equity portfolios rather than fixed income. This does not include other below investment grade securities such as bank loans and preferred equity, which present different risk-reward characteristics versus traditional high yield. As credit spreads narrow and the term structure steepens, fixed income investors may want to increase the credit quality of their portfolio as well as exposure to the long end of the curve, barring a major inflationary outbreak. This chart shows the forward valuations based on expected earnings over the next 12 months of the S&P 500, ex-US developed markets as represented by MSCI EFA, and the emerging markets as represented by MSCI Emerging Markets. When you flip the PEs into earnings yield, it basically implies long-term returns of roughly 5 to 7% for equities. Doesn't mean that that's what they're going to return this year. It's just that's going to be kind of an anchoring point based on how equities are priced today. I suggest reading Larry Swedrow's ETF.com article titled Predictive Nature of Valuations, which is published back in the fourth quarter. Larry summarizes the latest academic research on whether historical returns or expected returns embedded in valuations can forecast forward market returns. The upshot is that valuations aren't good at providing highly accurate forecasts of stock returns, but the valuations still matter with respect to expected returns, as well as the dispersion of possible outcomes. That said, earnings growth is what drives markets. Multiples may contract depending on the broader macro context, but generally in order for markets to advance, there has to be earnings growth. Current forward valuations of major market regions imply long-term expected returns of 5 to 7%. Note this does not mean that 2017 will only see single-digit market returns, but valuations matter as they anchor long-term expectations. So what about earnings? According to FactSet, analysts are forecasting 12% earnings growth this year, although this number will likely be revised down as the year progresses. However, it could be quite different this year depending on what expectations are in terms of fiscal stimulus. Apart from headwinds turning to tailwinds for energy and financials, quite a bit remains unknown about what will catalyze higher earnings so late into the business cycle and with inflationary pressures building up. The obvious one is a cut in corporate taxes, which would add about 10% to earnings according to Adam Parker from Morgan Stanley. Yet this impact could be diluted with some of that tax savings passed on to consumers, as well as some of that being offset by a stronger dollar, which would reduce the demand for U.S. exports. Regulatory relief could also unleash a new capital expenditure cycle, but this would take time to manifest its way through the economy via higher productivity. So key issues heading into 2017. Obviously, the big one is D.C. policies. What are we going to see coming out of D.C. in the way of tax reform, regulatory relief? Are there going to be restrictions on global trade and so forth? We believe much of the near-term market reaction will oscillate around expectations of what the Trump administration and the Republican Congress can deliver versus what has been promised in the areas of corporate and personal tax reform, infrastructure spending, and regulatory relief. As we head into the year, our global macro barometers exhibit strong momentum, providing a bullish backdrop for continued outperformance of what we deem cyclical risk. Despite region-specific risks such as populist candidates prevailing in 2017 European elections, geopolitical conflicts, and potential restrictions on global trade stemming from Trump administration policies, the macro backdrop and relative valuations should be supportive of global diversification rather than betting it all on a single market, even if it's just the U.S. And with yields having backed up globally, dividend-based strategies look more appealing from a valuation standpoint. As investors chase cyclical risk and potential credit imbalances start to form, one may also want to improve the quality of the equity portfolio without sacrificing broad market risk. So that is our presentation. If there are any questions at this time, feel free to ask them. You can enter them into the question box that's located on your screen. One question that has come up is looking at what happened in November and the market reaction. Right now, the concern is not only is that the U.S. market looks expensive, but small caps in particular look expensive. And again, this goes to this notion about, whether one should reduce their U.S. equity exposure or reduce their overall equity exposure in light of valuations. And I think what we found in the past is that trying to time your equity exposure around valuations, as confirmed by the Larry Swedroe piece, it's an uncertain way of trying to generate long-term returns. Long-term, investors are compensated for the risks that they take. Not to say that they're guaranteed to generate longer returns, otherwise there wouldn't be any risk involved in that, but just that rationally, capital markets price and embed a higher expected return in riskier assets, and that includes equities versus a risk-free alternative like cash or U.S. Treasuries. So, but that said, valuations also help, provide kind of that forward-looking expectation about what investors can expect out of the equity markets given what they're paying for today. And what we're looking at right now is about, I would say, mid to high single-digit expected returns over the longer run. But that could change depending on how markets progress throughout the year. We might see more opportunities to take on more cyclical risk. The longer term risk remains that this is an aging bull market. This is an aging expansionary cycle, even if it's under new normal conditions. Will recession risks start to get priced in, given that we're sort of in or approaching uncharted territory in terms of the length of the business cycle and this bull market cycle? Again, that's hard to time, particularly because if we're seeing a new regime that is going to introduce sort of more cyclical reflationary tailwinds through fiscal stimulus and so forth, then it could very well be that we extend this cycle, but by how much length, it's still unclear. So we did get one question also about the dollar. How much should we be concerned about dollar strength as we invest around the world? That certainly presents a risk from a global diversification standpoint. A strong dollar reduces the returns one generates from investing outside the U.S. market, whether in equities or fixed income. Again, I would say that much of the dollar strength we saw occurred in November. That's backed off a little bit. There is, I believe, still some risk that the dollar could strengthen versus Europe and Japan as central bank expectations for central bank policies diverge. I would say that Europe and Japan are not in a position right now where they can explore normalizing their monetary policy regimes, although they have backed off on pursuing negative rates in favor of trying to steepen their yield curves. But I would say that certainly dollar strength does remain a risk, especially if the U.S. economy starts to diverge and more inflation is seen coming into the U.S. versus other markets. But I would say at the margin right now, much of that strength we've already seen in November, and it does, strong dollar strength does present a risk right now, but certainly not something that would overwhelm the desire for long-term global diversification. So with that, we'll go ahead and conclude this commentary. Again, just a reminder, we're going to make a recording of this commentary available on the advisor section of our website, as well as the slide deck. And if you have any further questions, feel free to call into our office. Go ahead and put the number here. And certainly we can try and maybe set up a time to delve into a little bit further about thoughts going into 2017. With that, I wish everyone a Happy New Year.